Hello everyone, my name is Jeffrey Salazar, and today I'll be reporting all about the Chapter 18, which is the Defined Benefit Plan Accounting Procedures. So the objective is to understand the relation between fair value of plan asset and projected benefit obligation, to know the computation of employee benefit expense, to compute the remeasurement of plan asset, projected benefit obligation, and effect of asset ceiling, to recognize plan settlement, and to understand the treatment of asset ceiling. The benefit plan shall be viewed as sub-entity and distinct from the primary entity, which is the employer entity. Separates the sub-entity, maintains information that does not appear in the financial statement of the primary entity. Such information is kept only by the means of memorandum records and therefore not reflected in the general ledger account of the primary entity. The information contained in the memorandum records of the following sub-entity contains the following: A, which is the fair value of plan assets, which is the FVPA, and B is the projected benefit obligation, or PBO. The fair value of plan asset is the source of funds set aside in meeting future benefit payments. The projected benefit obligation, or the defined benefit obligation, is the present value of the expected future payment required to settle the obligation arising from employee service in the current and prior periods. The FVPA is analogous to an off-statement of financial position asset with a debit balance, and the PBO is the analogous to an off statement of financial position liability with a credit balance. These two items are kept only in the memorandum records of the sub entity. The prepaid or accrued benefit cost is the item that appears of the financial statement of the employer entity. If the VPA is more than the PBO, the plan is overfunded and therefore is a prepaid benefit cost or a non-current asset. If the FVPA is less than the PBO, the plan is underfunded and therefore there is an accrued benefit cost, a non-current liability. So as we can see in the illustration 1, it is example of underfunding. So the situation is, to simplify the example, the only component of the benefit expense in the current service cost of 500,000. The entity made a contribution of 450,000 to the defined benefit plan for the current year. The journal entry to record expense and contribution is debit employee benefit expense, which is 500,000, and credit cash 450,000, and prepaid or accrued benefit cost, which is 50,000. So in the illustration number 2, it shows example of overfunding. Again, the only component of the benefit expense is the current service cost of 500,000. The entity made a contribution of 600,000 to the defined benefit plan for the current year. The journal entry to record the expense and contribution is employee benefit expense, which is 500,000, and the prepaid accrued benefit cost is 100,000, and the credit will be cash 600,000. So, prepaid accrued benefit cost. Observe that the prepaid accrued benefit cost account is the balancing figure as the years go by. This account will build up. It may be the debit or credit balance at the end of the current reporting period. If the account has a debit balance, it is classified as non-current asset, presented as a prepaid benefit cost. Otherwise, if the account has credit balance, it is classified as non-current liability, presented as accrued benefit cost. So, next is the comprehensive illustration. So, at the beginning of the current year, the memorandum record in relation to a defined benefit plan showed the following. So, here the fair value of plan asset is 5 million and the projected benefit obligation is 7 million. So we will subtract to get the prepaid or accrued benefit cost, which is 2 million. During the current year, the following transactions are gathered. First is the current service cost, which is 1,200,000. Next is the past service cost, which is 300,000. Actual return on planned assets which is 800,000. Contribution to the plan, which is 1 million, and benefit paid, which is 500,000. Actual loss due to increase in PBO, which is 900,000, and the discount rate is 10%. So, in computation, the current service cost, which is 1,200,000, the past service cost, which is the 300,000. To get the interest expense on PBO, we will multiply the discount rate and the projected benefit obligation. So 10% multiplied by 7 million, it will get 700,000. And to get the interest income on FVPA, we'll multiply the discount rate and multiply to the fair value of planned assets, which is 5 million. So 10% times 5 million, we'll get 500,000. So all employee benefit expense is 1,700,000. So actual return on plan assets, which is 800,000. Interest income on FVPA, which is 500,000. Remeasurement gain on plan asset, which is 300,000, and actuarial loss due to increase in BPO, which is 900,000. And all net remeasurement loss is 600,000. So employee benefit expense, which is 1,700,000, net remeasurement loss, which is again 600,000. So total defined benefit cost. So it is just addition between employee benefit expense and net remeasurement loss. We will get 2,300,000, and contribution to the plan, which is 1 million. So we will subtract to get the accrued benefit cost during the year, which is 1,300,000. Next is the journal entry. So employee benefit expense, debit, which is 1,700,000. Net remeasurement loss 600,000. Credit cash, which is 1 million, and the prepaid accrued benefit cost, which is 1,300,000. So prepaid accrued benefit cost on January 1, which is 2 million. Credit adjustment or accrued benefit cost during the year, which is 1,300,000. And all we get prepaid accrued benefit cost on December 31, which is 3,300,000. And reconciliation, FVPA on January 1, it is 5 million. Contribution to the plan, which is 1 million. Interest income on FVPA, which is 500,000. And remeasurement and gain on plan assets, which is 300,000. And minus to the benefit paid, which is 500,000. And the FVPA on December 31, we will get 6,300,000. In simple approach, FVPA on January 1 is, since it is 5 million, contribution to the plan again, it is 1 million. Actual return to the plan asset, 800,000, and the benefit paid, we'll subtract it again, the 500,000. So FVPA on December 31 is 6,300,000. So PBO in January 1 is 7 million. Current service cost, which is 1,200,000. Past service cost is 300,000. The interest expense on PBO, which is 700,000, and benefit paid again, which is, we'll be subtracting it to 500,000. So the actuarial loss due to increase in PBO is 900,000, and PBO on December 31st will get 9,600,000. So FVPA December 31 will get 6,300,000, and PBO on December 31st it will be 9,600,000. So we'll subtract it and we will get 3,300,000. So next we'll get using the worksheet approach. So as you can see, the current service cost, the past service cost, interest expense on PBO, interest income on FVPA, contribution to the plan, benefit paid, actuarial loss on PBO, remeasurement gain on plan asset. And next, it will be the worksheet journal entry. So to record the current service cost, we'll debit employee benefit expense, which is 1,200,000, and credit projected benefit obligation, which is 1,200,000 also. So to record the past service cost, debit employee benefit expense, which is 300,000, and projected benefit obligation, which is 300,000. So to record the interest expense on PBO, so employee benefit expense 700,000, projected benefit obligation, which is also 700,000. So to record the interest income on income on FVPA, the fair value of plan assets, which is 500,000, employee benefit expense, which is 500,000. Fifth, to record the contribution to the plan, fair value of the plan assets, which is 1,000,000, and the cash 1,000,000 also. To record benefit paid, projected benefit obligation, which is 500,000, and the fair value of plan asset credit 500,000. To record actuarial loss on PBO, remeasurement loss 900 debit 900,000, credit projected benefit obligation, which is 900,000. To record remeasurement gain on plan asset, debit fair value of plan asset, which is 300,000, remeasurement gain, which is 300,000. So next is the settlement of plan. So a settlement is a transaction that eliminates all further legal or constructive obligation for part or all of the benefit provided under defined benefit plan. For example, one of transfers or of significant employer contribution under the plan to an insurance entity through the purchase of insurance policy is a settlement. So entities may settle their post-employment benefit plan by purchasing annuity contracts from insurance entities for less than the amount of retirement fund. A lump sum payment to plan participants in exchange for their rights to receive specified post-employment benefit is also a settlement. So however, PAS 19 clarified that a lump sum payment to a plan participant made under the terms of the existing defined benefit plan is not a settlement. So this is referred to as a routine settlement and considered an actuarial assumption that should be included in the measurement of the defined benefit obligation. The most obvious example of a routine settlement is the option to take a lump sum payment instead of an annuity or a periodic payment. So gain or loss on settlement. PAS 19 paragraph 110 provides that an entity shall recognize gain or loss on the settlement or defined benefit plan when the settlement occurs. The gain or loss on settlement is the difference between the settlement price and the present value of the defined benefit obligation on the date of the settlement. So that settlement price includes any plan assets transferred and any payments made directly by the entity in connection with the settlement. Any gain or loss on settlement is fully recognized and included in service costs and the computation of employee benefit expense. So in illustration, example, so at the beginning of the current year, the memorandum records of defined benefit plan show the following. Again, fair value of the plan asset is 4,000,000 and the projected benefit obligation, which is 5,500,000, and the prepaid accrued benefit will be 1,500,000. So during the current year, the following transactions are gathered: current service cost, which is 800,000, Actual return on the plan asset, 300,000. Contribution to the plan, 600,000. And settlement price of defined benefit obligation, which is 450,000. The present value of defined benefit obligation settlement is 500,000, and the discount rate is 5%. In computation, present value of defined benefit obligation settled is 500,000, and the settlement price is 450,000, and we'll subtract it to get the settlement gain, which is the 500,000. So current service cost is 800,000 subtracted to the settlement gain, which is 50,000. To get again the interest expense on PBO, we'll multiply the discount rate and the projected benefit obligation. So 5% multiply by 5,500,000, we'll be getting 275,000. And to get the interest income on FVPA, discount rate multiply by the fair value of plan asset. So 5% multiplied by 4 million, we'll getting 200,000. So employee benefit expense, it will be getting 825,000. So actual return on plan asset is 300,000. Interest income on FVPA, again the 200,000. So remeasurement gain on plan asset will get 100,000. So employee benefit expense is 825,000. Subtracted with the remeasurement gain, which is 100,000. Defined benefit cost, which is 725,000. Contribution to the plan is 600,000. And accrued benefit cost during the year, we're getting 125,000. Then using the journal entry, so debit employee benefit expense 825,000, credit remeasurement gain 100,000, cash, which is 600,000, and prepaid accrued benefit, which is 125,000. So prepaid accrued benefit cost on January 1, which is 1,500,000. The credit adjustment accrued benefit cost during year, which is 125,000. So there are prepaid accrued benefit costs on December 31, which it will be 1,625,000. So reconciliation. So FVPA on January 1, it is 4 million. The contribution to the plan is 600,000. Settlement price of defined benefit obligation less of 450,000. Interest income on FVPA, which is 200,000. And remeasurement on gain on plan asset will be 100,000. So FVPA on December 31st, we're getting 4,450,000. So the PBO on January 1 is 5,500,000. The current service cost, which is 800,000. The interest expense on PBO, 275,000. The present value of defined benefit obligation settled is subtract to 500,000. And the PBO on December 31st, it will be 6,075,000. And FVPA on December 31 again, it is 4,450,000. And PBO on December 31st, and it is the 6,075,000. So the prepaid accrued benefit cost credit is 1,625,000. So FVPA more than the PBO. If the fair value of the plan asset is more than the projected benefit obligation, the plan is overfunded, and therefore there is a prepaid benefit cost, which PAS 19 calls it surplus. So PAS 19 paragraph 64 provide that the surplus is defined benefit must be not exceed the asset selling determined by using discount rate in the measurement of the defined benefit obligation. The asset ceiling is the present value of any economic benefit available in the form of refunds from the plan or reduction in future contribution to the plan. So illustration, at At the year end, a defined benefit plan revealed the following data: fair value of plan asset, which is 6 million, and projected benefit obligation, which is 5 million. The prepaid accrued benefit cost, or the surplus, since VPA is more than the PBO, so it is surplus, and it is based on past 19 surplus, which is 1 million. So the asset selling, or the present value of available future refund and reduction the future contribution, is 1,200,000. So the surplus does not exceed the asset selling. Therefore, a prepaid benefit cost or surplus asset of 1 million shall be reported in the statement of financial position at the year end. So, comprehensive illustration. So, a defined plan revealed the following information at the beginning of current year. So, fair value of plan assets it is 4,500,000. Projected benefit obligation, which is 4 million. So, prepaid accrued benefit cost, which is the surplus again, since VFE is larger or more than the PBO, it is 500,000. So asset selling is 300,000. So we will subtract that, it will get the effect of asset selling. So the following data are provided for the current year. So the current service cost is 900,000. Actual return on plan assets is 1 million. Contribution to the plan is 700,000. Benefit paid is 200,000. Actual gain due to decrease in PBO, which is 300,000. Asset selling on December 31 is 800,000, and the discount rate is 10%. So past 19 paragraph 8 provide that any change in the effect of the asset selling, excluding interest and the effect of the asset selling, is remeasurement to be recognized through other comprehensive income. So paragraph 126 provide that the interest on the effect of the asset selling is part of the total change in the effect of the asset selling. The amount is determined by multiplying the effect of the asset selling at the beginning of the period of the discount rate. The difference between the total change in the effect of the asset selling and the interest on the effect of the asset selling is considered remeasurement. Any increase in the effect of asset selling is remeasurement loss minus interest expense on the effect on asset selling. Any decrease on the effect of asset selling is remeasurement gain plus interest expense on the effect of asset selling. So computation. On FVPA on January 1 is 4,500,000. Contribution to the plan, which is 700,000. Actual return on the plan asset, which is 1 million. And minus to the benefit paid, which is 200,000. So our FVPA on December 31 will get 6 million. So PBO on January 31, which is 4 million. So the current service cost is 900,000. Interest expense on PBO, 10% multiplied by 4 million, will get 400,000. Actual gain due to decrease in PBO, which is 300,000. Benefit paid again, which is 200,000. So our PBO on December 31st, it will be 4,800,000. So FVPA December 31, which is 6 million again, and PBO December 31 is 4,800,000. So our prepaid or actual benefit cost, which or surplus, is 1,200,000. So our asset selling is on December 31 is 800,000. So the effect of asset selling is 400,000. So the current cost is 900,000. The interest expense and PBO, which is 10% multiplied by the 4 million, which is 400,000. The interest income on FVPA, or 10% multiplied by 4,500,000, will get 450,000. And the interest expense on effect of asset selling, to get that, we'll multiply 10% to the 200,000, which is 20,000. So employee benefit expense, it will be 870,000. So our actual return on plan asset, which is 1 million, our interest income on FVPA, which is 450,000. Remeasurement gain on the plan asset, so we will subtract to get remeasurement gain on plan asset, which is 550,000. So actual gain or decrease in PBO, which is 300,000. So the effect of asset selling on December 31 is 400,000. Effect on asset selling on January 1, which is 200,000. So the total change in the effect of asset selling, which is the difference of 2, so we'll get 200,000. So interest expense and effect of asset selling on January 1, 10% multiplied by 200,000, we'll get 20,000, and we'll subtract it to the total change and effect of asset selling. So to get we get 180,000 as a remeasurement loss on asset selling. So in the memorandum record, which is same category as the actually the effect of asset selling is a credit projected benefit obligation. Any increase in the effect of asset selling is remeasurement loss. Any decrease in the effect of asset selling is remeasurement gain. However, the portion attributable to the interest of the effect of the asset selling is included in the profit or loss as the component of employee benefit expense. The remainder is the remeasurement recognized as the component of other comprehensive income. So next is this. So remeasurement gain on plan asset, which is 550,000. So the actual gain due to decrease on PBO, which is 300,000. Remeasurement loss on the change and the effect of asset selling, which is 180,000. Net remeasurement gain, 670,000. Employee benefit expense, which is 870,000, minus the net remeasurement gain, which is 670,000, and we get the defined benefit cost, which is 200,000. So contribution to the plan, which is 700,000. So you will subtract it to get the prepaid benefit cost during the year, which is the 500,000. So we'll debit employee benefit expense, which is 870,000, and the prepaid accrued benefit, which is 500,000, and then credit remeasurement gain in 670,000, and the cash, which is 700,000. So on reconciliation, prepaid accrued benefit cost on January 1, asset selling, which is 300,000. Debit adjustment prepaid benefit cost during year, which is 500,000. So our prepaid accrued benefit cost on December 31 is 800,000. Note that the prepaid benefit cost on December 31 is 800,000, which is equal to the asset selling on December 31. So transitional provisions. So revised PAS 19 paragraph 173 provides that the entity shall apply the standard retrospectively. This means that any transitional effect on the application of the amendments under PAS 19 shall be accounted for adjustment of the beginning balance of retaining earnings. However, an entity need not adjust the carrying amount of asset for changes in employee benefit costs that were included in initial carrying amount of the asset. In other words, assets such as inventory and property, plants, and equipment that includes employee benefit costs in their carrying amount do not have be restated. So illustration, on January 1, 2020, the memorandum record showed the following. So fair value of plan asset, which is 4 million, unamortized past service cost, which is 400,000, unrecognized actuarial loss, which is 500,000, subtracted to the projected benefit obligation, which is 1 million. We'll get the prepaid accrued benefit, which is 1,100,000. So on January 1, 2020, the entity applied the revised PAS 19 in relation to the recognition of past service costs and actuarial gain and losses. Effective January 1, 2020, all past service costs during the year are fully recognized in profit or loss. All actuarial gain and losses during the year are fully recognized in other comprehensive income. So, disclosure defined benefit plans. So, a characteristic of defined benefit plan entries associated with the plan. B is the reconciliation for a fair value of plan asset and the present value a defined benefit obligation. C. Separated showing of current service costs, past service costs, interest expense, or income and remeasurement. D. Disaggregation of fair value of plan asset into classes that distinguish the nature and risk of asset. E. A sensitivity analysis for each significant actuarial assumptions showing the effect on the defined benefit obligation for any changes. F. Description of any funding arrangement and policy. G. Expected contribution to the plan for the next period. And H is the maturity profile of defined benefit and obligation. And lastly, we'll get is the PAS 26. So this standard deals with accounting and reporting by retirement benefit plan. It is the standard for the preparation of general purpose financial statement or financial reports of retirement plan, which may be defined contribution plan or defined benefit plan. In a rare cases, a retirement benefit plan may contain characteristics of both defined contribution plan and defined benefit plan. So, for purposes of these standards, such as hybrid plan is deemed to be defined benefit plan. Report or defined contribution plan. The report of a defined contribution plan should contain a statement of net asset available for benefits and description of funding policy. In preparing the statement of the net asset available for benefit, the plan investment shall be carried as fair value. When plan investments are held for which our estimate is not possible, the reason why fair value is not used shall be disclosed. In practice, in many cases, plan assets will have determinable fair value because in the discharge of their fiduciary responsibility, plan trustees will mandate the retirement plan hold only marketable investment. That's all. Thank you.